Hello, everyone. I hope you're doing well. Welcome back to the channel. Again, just for reference, I am not an insurance agent. I am not a financial advisor. I am just an individual who really likes personal finances, but also the infinite banking concept. Today, what I want to cover is this idea of an adjusted cost basis. And I think this is the number one most impactful difference between American infinite banking and Canadian infinite banking, at least as I understand American infinite banking. So essentially, what traditional IBC, uh, the concept is, and I'll re-explain this, is you earn dollars, and the idea is you funnel it into a IBC vehicle, which just so happens to be a whole life insurance policy. You then leverage this policy to make investments and or spend, and from the return of this investments, you pay back the leveraged, which in turn increases the rather re-increases or brings the amount of money back in your infinite banking policy back in line. And then of course you just kind of rinse and repeat this cycle, and this obviously continues to compound at a favorable interest rate. So this is the idea here. Now, in the traditional infinite banking sense, they would say that you should be taking out policy loans in order to leverage against the policy. Now, one of the big things about infinite banking is that you really have access to these funds whenever you need them, however you need them. Nobody asks questions. That is how it is sold. And by and large, that is true for the overwhelming majority of life and use cases. But you don't want to be caught off guard. So you need to be aware of this. So the adjusted cost basis is essentially the way the government determines how they're going to tax any withdrawals from a policy, including withdraws via a policy loan. And so essentially, the way this ends up working is the adjusted cost base in general, and I'm not an accountant, okay, and I know there's exceptions to this rule, all right, is going to be the premium paid minus your net cost of pure insurance, okay? And so the way this ends up working is, let's say for example you're just say a 30-year-old male. I'm making up these numbers, by the way. I don't actually know what the net cost of pure insurance would be for a 30-year-old, but let's pretend it's a $10,000 premium and the net cost of pure insurance would be $300 for that year. You would be left with an adjusted cost base of $9,700. Now, if this is year one, most infinite banking policies typically lose 20 to 30%, and so you'd only have, say, $7,000 to $8,000 on average of actual cash value. So you could, in theory, withdraw, take a policy loan for all of this amount of money, and you would still not hit your adjusted cost base. So, how this actually goes is usually what ends up happening is your adjusted cost base increases for the majority of your life and then kind of very quickly falls down. And usually, what ends up happening is the growth in your policy starts lower and then kind of catches up to the point where all of this inside of here ends up being taxable gains if you go ahead and do any withdrawal. And in Canada, and this is the key difference, policy loans from a taxation basis are considered withdrawals. So if you go and let's pretend, 20 years down the road, you have a difference here. Let's say you have a total cash value of, I don't know, say $200,000. And let's pretend your adjusted cost base, again, I'm making these numbers up, is $100,000. Well, you would be able to take a policy loan out. Let's pretend you can leverage 100% of it. Okay. Let's say you go and you take a policy loan out for $200,000. Well, you are going to end up being taxed on $100,000 of this, which is the difference between the two numbers, right? And that can come to quite a shock, especially if you're believing and listening to the traditional infinite banking methodology or processes, right? So keep this in mind. Now, the way to get around this under current taxation, and of course anything can always change, is when you have your whole life policy, you actually put it up for collateral and you go get yourself a secured line of credit, similar to a home equity line of credit, but instead of your house being over here, it's going to be your whole life insurance policy, and the interest rates actually are usually way better than they are if you take a policy loan directly from the insurance company. And so at the end of the day, this is something you kind of want to do sooner rather than later, but I'll have another video coming out on that shortly. So I hope that makes sense. You have to be aware of this, or else it can really, really mess you up, because the taxes payable can get quite high, especially later on the road, down the road, right? As these cash values end up increasing. And yes, by the way, this adjusted cost base eventually comes down to the age, rather the amount of zero. So typically speaking, and every policy is going to be slightly different, it seems like the adjusted cost base ends up being lower than the cash value in about year 5 for most IBC policies. Okay. And the more aggressive you are, the more cash value you have, the closer this is going to be, the lower it's going to be. And I ran a few illustrations, and typically you're going to have a cost basis of $0, meaning your entire amount is taxable uh, in your 80s, as in terms of age. But I ran that off of a 30-year-old, so that's probably not accurate for everyone, but you get the idea. Anyway, let me know if you have any questions in the comments below. If you agree with me, disagree with me, let me know. If you disagree with anything I've said, any concepts I've said, let me know. I've had a few practitioners comment below, and they'll say something, I'll respond, and then I typically never hear from them again, and it's a shame. Um, because they're probably thinking, hey, he just doesn't understand. But really, here to learn, here to have the conversation, here to demystify the entire IBC process so that people are more informed. And ultimately, I think this is just going to be better for everyone. So, everyone, have yourself a wonderful day.